Here is a figure that deserves careful attention. During the last 2 months alone, individual investors, ordinary people, and households across the country directed $80 billion into the U.S. stock market. $80 billion in just 2 months. That amount exceeds twice the average monthly inflow recorded across all of 2024 and 2025 combined. What makes this notable is the timing. Those funds entered the market while the S&P 500 remained close to record territory, after already advancing nearly 20% since March. In practical terms, investors purchasing today are paying some of the highest valuations ever seen for ownership in the American economy. Most people respond to that information in one of two ways. Some become enthusiastic, others become concerned. The reaction often depends on whether they already hold investments or are still waiting on the sidelines, but neither response is the most useful one. A more important question exists, and it is remarkably specific. Are we looking at a situation similar to 1996, or are we closer to 1999? The answer may be more valuable than any headline discussing market excitement. There's also a reasonably straightforward way to approach it. First, consider valuations. This is where much of the concern originates, and where considerable misunderstanding appears as well. One widely followed metric is known as the Shiller P/E ratio. It measures the market's current price against the average inflation-adjusted earnings generated during the previous 10 years. Using a decade of earnings helps reduce distortion. A single year can be heavily influenced by either a recession or an economic surge. A 10-year average provides a steadier and more representative benchmark. Imagine purchasing a private company. You would not evaluate it solely on the profits from the most recent year. You would want to understand its typical earnings across a longer period. The Shiller P/E ratio applies that same concept to the entire S&P 500. At present, this measure stands near the highest levels observed during the past 100 years. It is above the readings seen in 1929 and also higher than those recorded in 1965. Only one period produced similar levels, the closing years of the 1990s. That era preceded the dot-com collapse, during which the market eventually declined by roughly 50%. For anyone with $10,000 already invested, or for someone considering placing $10,000 into the market, that historical perspective matters. It does not automatically indicate a reason to sell, nor does it provide a signal to buy. It simply shows that current purchases are being made at elevated prices when compared with a century of earnings history. That is the numerical reality. Many financial news outlets have used these valuation figures as justification for terms such as market euphoria and speculative excess. Interestingly, similar headlines were already appearing in July of 2025. Since that point, the S&P 500 has gained another 25%. That fact alone demonstrates that expensive valuations are not, by themselves, a reliable sell indicator, which leads to the central issue. The real question is not whether stocks are costly. The real question is whether the conditions exist today that could transform a normal correction into a major market decline. This is where the discussion becomes especially compelling. Once you move beyond valuation metrics and examine the broader economic environment, the landscape begins to resemble the 1990s, and perhaps not in the way many people would expect. Real GDP growth in the United States is currently running at approximately 2.7%. That is a healthy figure. Even after the recent conflict in the Middle East, economic activity has remained resilient. According to projections from the Federal Reserve, growth could approach 4% during the second quarter of 2026. If that occurs, the economy would be operating within the same general growth range that defined the expansion period of the mid to late 1990s. Looking back across the past 40 years, major market advances have often occurred during periods when economic growth remained within this range. The pattern is fairly straightforward. Equity markets usually struggle when economic activity weakens or moves into contraction. They generally perform better when growth continues at a steady pace. By that measure, today's environment appears supportive. The Federal Reserve has also followed a path that closely resembles conditions from the late 1990s. Beginning in mid-2022, policymakers maintained a stable stance on rates before gradually moving them lower. That mix of factors, consistent economic expansion, easing rates, and more accommodative financial conditions, has historically been favorable for stocks. Investors recognize that reality. It helps explain why $80 billion recently flowed into the market. At this stage, it is easy to reach a conclusion. Elevated valuations may exist, but economic fundamentals remain firm, and Federal Reserve policy appears supportive. It might seem reasonable to stay fully invested and put concerns aside. However, one factor has changed, and that change alters the entire picture. Understanding the mechanism is important because this is where the broader story begins to matter. During the late 1990s, the Federal Reserve had the ability to reduce interest rates for a specific reason. Inflation was moving downward. It dropped from roughly 3% in 1996 to 1.5% by 1998. That decline created room for rate reductions, helping fuel the powerful rise in stock prices. Then conditions shifted. Inflation began moving higher again, rising from 1.5% in 1998 to 3.7% by 2000. As inflation climbed well beyond the Federal Reserve's 2% objective, policymakers were compelled to change direction and increase rates. The significance of that development cannot be overstated. When interest rates rise, borrowing becomes more costly for companies. As financing expenses increase, businesses become less aggressive with expansion plans. Hiring begins to slow. If elevated rates remain in place long enough, workforce reductions can eventually follow. Fewer workers mean less income from wages. Reduced income leads to weaker consumer spending. Consumer spending accounts for approximately 70% of the U.S. economy. When that spending slows, GDP growth comes under pressure and can eventually slide into recession. That sequence unfolded between 1999 and 2001. It was also the process that preceded a market decline of roughly 50%. Now consider present conditions. Inflation fell from a peak near 9% during 2022 to 2.4% by early 2026. That decline provided the Federal Reserve with room to begin lowering rates. At the time, the outlook appeared to point toward a soft landing. But since the start of 2026, inflation has turned higher once again. It has increased from 2.4% to 3.8%, moving farther away from the 2% target rather than closer to it. That is the comparison deserving attention, not valuation levels, not retail investment inflows. This. If inflation continues to rise, the Federal Reserve could find itself with little alternative but to increase rates again. Should that occur, the same progression that contributed to the market collapse around 2000 becomes a realistic concern in the current environment. Higher rates slow hiring activity. Slower hiring weakens consumer demand. Reduced spending places pressure on economic growth. Markets then adjust sharply to reflect those weaker conditions. Yet there is another detail that often disappears from the discussion. This process does not unfold immediately. Historical evidence shows a measurable delay between Federal Reserve rate decisions and their impact on employment. Past data suggests that changes in interest rates typically influence the labor market approximately 12 to 14 months after those decisions are made. Companies do not begin layoffs the day after rates move higher. Time is required for increased borrowing costs to filter through business lending, growth initiatives, and employment planning. That is precisely how events unfolded throughout the 1990s. The Federal Reserve started raising rates in January of 1999. Job growth did not begin to decline until March of 2000, 14 months later. During that period, the S&P 500 climbed an additional 25% before the market correction began. Even if the Fed were to start increasing rates in the second half of 2026, the full economic impact would likely not be seen until the second half of 2027. That does not mean the risk is negligible. It means understanding the timeline is critical. Right now, the economic data shows job creation is still exceeding 120,000 new positions each month. GDP growth remains solid and does not yet reflect the weakening that typically signals a recession. The risk exists. Its effects are not immediate. Both statements are true simultaneously. For someone with $10,000 invested today, the focus is not on panic selling. The focus is on knowing what indicators to monitor and when a meaningful shift occurs. Rising inflation serves as the first warning. Federal Reserve rate hikes are the second signal. Job creation dropping below roughly 100,000 new positions per month and trending downward is when the economic transmission mechanism begins to take hold. Monitoring these three factors in sequence is essential. It is worth pausing because this is a lot to absorb. The Shiller ratio, the Fed's implementation lag, inflation reversals, and the employment chain, these are real mechanisms that analysts spend careers studying. In about 10 minutes, you have traced all of them. That is important because much of the media noise, headlines about mania, euphoria alerts, or emergency updates, does not reveal the underlying mechanisms. It presents conclusions and expects an emotional response. Understanding the processes underneath gives more durable insight than fear or reassurance. It provides a framework to actually observe. Based on everything we have reviewed, the honest answer is that current conditions resemble 1996 more than 1999. Economic growth is healthy. Job creation has slowed but has not contracted. The Fed is not actively raising rates. Inflation warning signs exist, but downstream effects have not yet appeared in employment statistics. That describes the 1996 snapshot. Elevated valuations, optimism in the market, yet an economic engine that continues to operate. What transformed 1996 into the year 2000 was a sequence. Inflation rose, the Fed responded with rate hikes, the hikes eventually suppressed job growth, declining employment reduced consumer spending, the spending slowdown weakened the economy, and the market dropped by 50%. That sequence has a clear beginning, middle, and end. At present, we are at the beginning, not the end. The next phase to watch is not whether to buy or sell. It is what unfolds when a central bank faces the decision of fighting inflation while supporting growth simultaneously. That is the choice the Federal Reserve is approaching. The last time they faced it, the outcome was far from smooth. That story comes next. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.